Hello and namaskar viewers. I am Sanjeev Pandya welcoming you to this week's episode of the Tax Talk with AJ. The show is brought to you by Science CPA Services, a full-fledged, complete professional accounting firm with multiple locations in the state of New Jersey. But they can assist you with any tax matters, corporate or personal tax matters. They can assist you wherever you are in the United States of America. They can be reached at 908 888-8900 or visit their website, which is scicpsservices.com. This is the show brings you all that you really need to know when it comes to taxes. And Science CPA Services believes in doing taxes right. Whatever that taxes needs to be paid must be paid. But on top of that, whatever deductions that you're entitled to, you must get those deductions. And Science CPA Services is the one that helps you to get all the deductions that you really need to get. They're knowledgeable, on-hand, experienced CPAs in the staff. They will assist you and making sure that whatever deduction you are entitled to, you get that, so that way your tax liability is reduced. Remember, taxes that you must pay, but how you can save on taxes, that's what Science CPA Service is all about. Once again, they can be reached at 908-888-8900 or scicpsservices.com. With that note, I'd like to welcome Mr. AJ Kumar of Science CPA Services with over 25 years of experience in this tax and accounting field. He's a CPA, CBA, and MBA with Science CPA Services, and it brings a wealth of knowledge and experience when it comes to taxes, accounting, and businesses. AJ, welcome to the show.
Thank you, Sanjeevji, and thank you for the kind introduction.
You're most very welcome, and because I know Science CPA Services all these years, and I know their services, and I know that how you and your staff have built a reputation so high, helping out clients, multiple clients in a business category, in a personal category throughout the USA. And I know you're going to get busy from next year, just a couple of weeks away, and you're going to have a busy schedule as a CPA.
Absolutely. Season is always busier than the normal times, and it generally starts from 1st January onwards. We'll have W-9, 1099s, W-2s. A lot of work happens before the tax filing actually starts.
Yes, absolutely. And by end of January, a month from now, you're going to be really, really busy, drinking coffee or tea every 10 minutes to get the things done. But anyway, folks, today we're going to talk about what's in the store for you when it comes to tax benefits, 2025 tax guidelines when it comes to deductions and the credits. Mind you, there have been a few changes, a few significant changes as part of President Donald Trump's big, beautiful bill known as BBL. So AJ is going to give us a lot more information that we really, you and us, we really need to know when it comes to 2025 taxes, which we will start filing come end of January. AJ, so let's start with standard deductions, what has changed, and the credits and everything else it follows.
Absolutely, Sanjeev, rightly put. So we have some changes every year anyway. The standard deduction, itemized deduction, the limits, income threshold changes every year. But this year is different. Not only we have this OBB1, one big beautiful bill they call it, we have a lot of new changes, new provisions. So you need to know what can benefit you. The onus remains on you to take the maximum tax benefit. If you don't claim a benefit, the system, IRS wouldn't come back to you, tell you that you missed this benefit. You should take this benefit. Today we are talking about deductions and tax credit. When it comes to deduction, everybody is familiar with standard deduction. Now they have new limits for the standard deductions under OBB, one big beautiful bill. For single person, the standard deduction is $15,750. For married filing joint person, the standard deduction is $31,500, much higher than the last year. They have a new deduction added this year under this one big beautiful bill again, which was not there last year. Seniors, if you are over 65 and have income below certain thresholds, $75,000 per person, married filing joint, $150,000, you get additional $6,000 per person of deductions over and above the standard deduction. Remember, you have the right to claim itemized deductions if your itemized deductions are higher than standard deduction. So you can pick and choose. You can try to compute your itemized deduction, and if your itemized deductions are lower than standard deduction, use standard deduction. If itemized deductions are higher than standard deduction, then use itemized deduction, whichever gives you the more benefit.
Okay. And what about the credits? That's a standard deduction, and as you said, it changes every year. So obviously there is a change for these shares also. What about the credits, starting with the medical expenses?
So medical expense is still a deduction, Sanjeev ji. So medical expense is part of itemized deduction. So if you talk about medical expense first, before we get into credit, so there are several itemized deductions. Say, for example, medical expense is there, then you have SOLT deduction, state and local tax deduction, which is now increased to up to $40,000, which used to be capped at $10,000. There are income limits. I mean, if you are making more than $500,000, then it goes down to $10,000. It phases out to $10,000. But for all practical purpose, now the 10,000 cap has been increased to 40,000. So it should save you a lot of money with the itemized deduction if you qualify.
That's a significant increase.
It is.
From
It is very,
10,000 to
very good. I
40,000.
mean,
Yeah.
especially if you own a home. What's included in SOLT is the state taxes, the local taxes, the property taxes, and the sum total of it is capped now to $40,000. Especially for people who are making less than $500,000, this one change alone can save you thousands of dollars.
Wow.
If you own home.
Absolutely.
Then we have charitable contribution. Some gambling losses, miscellaneous deduction, all these deductions goes on Schedule A. We call it itemized deduction. Mortgage interest, medical expenses, property tax, state and local tax, charitable contribution. Just remember, medical expenses are limited to more than 7.5%. Your medical expenses have to be in excess of 7.5% of your AGI. So if your AGI is $100,000, your medical expense is $10,000, only $2,500 count in excess of 7.5%. So you just have to be cognizant about the rules, the regulation around it. At the end of the day, Sanjeev ji, the idea is you calculate your itemized deduction, and if your itemized deduction is higher than the standard deduction, then you should claim itemized deduction to get the maximum tax benefit.
All right, good. It's still deduction. We haven't got to credit
Right.
part yet, so it's still deductions. I mistakenly says, a credit part, but it's still deduction. What about retirement contribution, HSA, and education deduction?
They are also deduction, rightly put, Sanjeev ji. So they are not part of standard deduction or itemized deduction. It's a separate concept. You can use either of standard or itemized, one of them, but you can definitely use all these FSA contribution. You can also use IRA contribution, SCP contribution if you have a small business. So there are a lot of other retirement-based contributions that can lower your taxable income as long as you have a qualified plan, and there are a lot of them. Depending on your situation, if you have a business, how much money you are making, and depending on your choice, do you want to contribute to pre-tax, post-tax? So contribution to a retirement plan can potentially reduce your taxable income over and above the itemized or standard deduction.
Okay, interesting. So now, having touched base upon this, standardized deduction, let's look into the credits. Earned income credit, child tax credit. Let's have information on that part.
Absolutely. So let's understand the difference first one more time. So deductions reduces the taxable income, while credit reduces the actual tax liability.
Correct.
So take an example. If your taxable income is $100,000, and let's say you are paying $20,000 in taxes based on 20% tax rate. So if you have a $10,000 of deduction, it reduces your taxable income from 100 to 90,000. So you pay 20%, 18,000 in taxes as opposed to 20,000. But if you have the same 10,000 of credit, it reduces your tax liability from 20,000 to 10,000. So if you have an option, and in many cases you truly don't, but if you have an option, you want to choose the credit over the deduction. Now let's talk about what are the main credit. You rightly put, Sanjeev ji, child tax credit is one of the most common one. And again, with one big beautiful bill, there are a lot of changes to it. Now the child tax credit can be $2,200, out of which $1,700 is refundable credit. So let's take another step and let's define what's refundable versus non-refundable when it comes to tax credit. So the tax credit again reduces the tax liability. In the sense, whatever you tax you owe, it reduces the taxes dollar for dollar as opposed to reducing the taxable income. Now, some of these credits are refundable, meaning let's say if you owed $1,000 to the government and you have a credit of $2,000, this credit is limited to $1,000, meaning the credit is limited to the extent of the tax liability. It's not refundable. For example, child tax credit can be up to $2,200 per child, per qualified child, but only $1,700 is refundable. If your total tax liability is $1,000, will give you $700 back, even though your credit is $2,200. If your tax liability is $3,000, for child tax credit will give you the benefit of $2,200, so now you owe $800.
Okay.
So child tax credit, then you have child care.
Child and
Dependent care
credit, yes.
flexible spending account. If you have an FSA, like HSA, HSA is healthcare spending account, you have FSA where you can use child care, dependent care tax credit. That can be up to $1,200 depending on, or 12% or 20% of what you're spending. $1,200 or 20% of what you spend for the dependent care. Then you have earned income tax credit.
Correct.
Earned income tax credit is a misnomer. Earned income tax credit is given to people where the income is not high enough, where their earning is not high enough, they qualify for this earned income tax credit. Then you have American opportunity tax credit. Again, they are all credits. They reduces your tax liability dollar for dollar. So American opportunity tax credit could be up to $2,500 per child for the first 4 years of their education, college education. Then after the American opportunity tax credit, you see the lifetime learning credit. Lifetime learning credit is for older folks after the schooling if they are still learning something new.
Up to $3,000.
Up to $2,000.
$2,000.
So it's $2,000 per person. Just remember, for the same child, you cannot claim this both credit,
Yes,
American
absolutely.
opportunity tax credit as well as the lifetime learning credit is after the post-secondary education, after the first 4 years of education. So for the same child, you cannot claim both. But if you have, let's say, 2 children, for one, you can potentially qualify for American opportunity tax credit. For the second one, you can qualify for lifetime learning credit. You can
Interesting.
yourself qualify for lifetime learning credit. So there's no age limit on lifetime learning credit.
Absolutely.
There are income limits though. You have to be careful. Depending on how much income you make, you may not get the same benefit or the full benefit in some cases.
Okay, very well said. This credit explanation is very helpful. So, maybe it's safe to say that standard deduction are the rights as a taxpayer that you get those standard deduction. But the credits, various credits, it's a privilege to have that, so that way your tax liability reduces dollar by dollar, correct?
Absolutely. And the way I want our viewers to see, based on the current government system, they are both privileges. They are both are benefits given by the government. And as much as right now we know 37% is the highest income tax rate, and 37% plus the state tax rate is absurd high. I mean, half the income is going into taxes. But believe me when I say it, currently the tax rate that we have in this country are one of the lowest one.
Okay. All right, very well said. With that note, we're going to take a short break. When we come back, we're going to continue this conversation on the deductions and expenses and the credits and everything. A lot more very valuable information coming your way right after these messages. Welcome back to the second half of the Tax Talk with AJ. As you know, the show is brought to you by Science CPA Services, a professional accounting firm located in state of New Jersey, can help you with any tax matters, personal or corporate tax matters. On top of that, in case if you are in the IRS tax audit, they can also assist you with IRS tax audit matter. So give them a call at 908-888-8900 or sciepaservices.com, and they can also assist you with virtual CEO, CFO, and the bookkeeper in your business, so that way you can focus on business. Now, moving on to the show, today's topic is tax deductions and the credits and all that you need to know for the year 2025. That means 2025 is going to end very soon, and now next year in 2026 we're going to be filing a tax return for the year 2025. In the first half of the show, AJ ran down all the deductions and deductions and credit information. Now we're going to go into a little bit of more deeper and to get you more information when it comes to deductions and everything. So AJ, my question is, what are the common deductions for the year 2025?
So a lot of them. It depends on your situation. Individuals have a different situation. Businesses have a different situation.
This is itemized deductions. Let's talk about
Absolutely. So for individuals, it's specific to itemized deduction. From the chart top down, you have medical expenses, you have mortgage interest, you have property tax, you have estate tax, you have charitable contribution, you have miscellaneous deduction, you have gambling income losses. They're all falls part of the itemized deduction for individuals.
Okay, but I guess there are some normal ones and there are some specific ones, right? Now, because not one deduction or one category
100%.
applies to everybody.
Absolutely. So if you are not a homeowner, more than likely you will be using a standard deduction, not the itemized deduction. If you have a health insurance where the insurance is provided by your employer for a W-2 person, you probably won't have significant medical expenses to claim anything. Remember, medical expenses have to be in excess of 7.5% of your AGI.
Yep.
So a lot of people don't have high enough medical expenses. So you have to look at your situation. Your point is well taken, Sanjeevji. Not everything applies to everybody.
All right, so now we talked about that personal deductions. Let's talk about business. What are the common deductions for businesses for the year 2025?
Absolutely. So it depends on business to business, but in general, you have cost of goods sold. Whatever you are selling, you are buying it first. So there is some money going out. If you are a consulting service business, then you have employees probably. You have staff, salaries, payroll taxes. You have an office, probably you have rent, lease, or property tax expenses around it. If it's a triple net, you may have other expenses around it. Then you have travel expenses. Then you have meal expenses. Remember, meal expenses are claimed only 50%. The theory is when you are going out with a client, only the client portion of the meal is deductible. And it has to be regular and usual for your type of business. You can't say, generally I go to Taco Bell, but for this client, I went to this fancy restaurant and it costed me $500 for the lunch. That's not going to fly. So it has to be usual, it has to be regular in your type of business. Then you have a lot of other expenses, professional fees, legal fees, business startup cost, machinery, R&D. So depending on your type of business, the example I generally take for a grocery store owner, even the grocery, buying the grocery is a business expense. For me, TV or couch is a business expense because I have a TV, I have a couch in my office. So depending on your situation, you have to see, is this expense a usual, normal, regular expense for this type of business? Most accounting firms will have a table, a couch, or some chairs, and those expenses are normal and usual for this type of business.
Interesting. All right, talk about businesses. What exactly is qualified business income deduction?
I'm glad you brought it up. I almost missed it. It's a beautiful thing. They call it QBI. It came around in 2017, Tax Cut and Job Act. The idea was the first 20% profit from an LLC or an S Corp, it has to be a flow-through entity, not for C Corps, is not taxed anymore. So this provision was about to sunset next year. But now they have made it permanent. So with QBI, a qualified business income deduction, first 20% of your profit from an S Corp or LLC is tax-free. That's QBI for you.
Interesting, very interesting. Now let's just go into the personal tax deduction matter, because we covered the personal and the business. So now the question I have is for you: what is the taxpayer should really do when it comes to planning for 2025 taxes on a personal basis?
A lot of things. So right now you have some time off, hopefully. Find out all the receipts, find out the donation receipt, find out the medical expense receipt, try to create a profile for yourself, know how much income you are going to have, see where else you can invest. Do you qualify for IRA? Does your business allows you to invest into 401k? Do you still have the option to maximize 401k through your job? If you have a small business, a side hustle, see how much the net income you are going to get. Try to create a P&L, profit and loss statement for your small business to identify what expenses are there. Are there some expenses that you can pull forward? So let's say the rent is supposed to be paid on 5th January. Can you pay it on 25th December? So you can claim it this year. Depending on your income, the idea here is try to do the paperwork, try to find the receipts, try to reconcile your income, expenses, and then make the decision what makes sense in your case. Is it a good idea for you to pull forward some of the expenses, meaning pay some of the expenses that are typically going to be paid in January, in December, or does it make sense for you to push some of these expenses to January, vice versa? Remember, there are dates around it. Say, for example, 401k contribution must be done prior to December 31st. SEP has the deadline for March 15th. Your IRA has the deadline for April 15th. So be cognizant of the timeline while you're making these decisions. That's why it's important to have that conversation, that planning done right now.
All right. Does it mean the same for business owners also while they are planning 2025 taxes?
A similar concept. It goes a little bit hairy for the small business owners. They also have to see how they performed in last couple of years. Especially if you have loan, if it's a leveraged business, the bank wants to see continuous growth in the business. You have to be careful. Last year you showed a profit of 80,000. Do you want to show 90,000 this year? In order to show 90,000 this year, do you need to pull expenses from the next year, or do you need to push expenses to the next year? So with business owner, it gets a little bit more complicated. You have to be looking at your personal tax, you have to be looking at your business tax, and you have to be showing continuous growth for your business. It also depends what type of business you have. Is it flow through or a C corp type of business where the taxes are paid at the business level? If it's a C corporation, be cognizant of the estimated tax payments as well. If you expect to owe more than $1,000, you're expected to pay some estimated taxes throughout the year. Don't assume that I'll pay the taxes on April 15th when I file the taxes. In that case, there will be some interest and penalties around it. If you owe money, you're expected to pay during the year. The last deadline for the estimated tax filing for this year is January 15th. I mean, we talked about a lot of deadlines, December 31st for the 401k, January 15th for the fourth quarter's estimated tax payment. Then we have March 15th for the business tax filing. SCP, we have January 31st for the 1099 filing. So for business owners, a little bit hairy, a little bit complicated. You have to know a lot of deadlines and a lot of limits around it.
Okay, all right. Quickly, you mentioned meal expenses in the business category, and that was enough information you gave. What about vehicle expenses? Is vehicle expenses deductible for businesses?
Absolutely. If your vehicle is regular, usual for your type of business, and you are using it for business purpose, it's allowed. I mean, you can't really say, I'm buying a Ferrari or something else, and very, very expensive car, and I'm running a grocery store. I mean, not that people don't have it, but is it really needed for this type of business? I mean, how is this vehicle adding value to this business? If you have a truck, it makes sense for a grocery store. If you have a regular car for an accountant, it makes sense. So you have to be cognizant about it, that you are not misusing the deduction.
All right. So as we are just winding down, the taxes matter for the personal and the businesses. Quickly, can you just touch base upon the common errors that taxpayers make before the tax season starts? That means between now and December 31st, what can they do to save a tax liability?
Absolutely. Please check. If there's one thing you can do, please check your pay stub. Make sure your name is spelled correctly. Make sure your social security number is there and is right. and make sure you know how much income you are going to have. Then accordingly, see if you can maximize the 401k plan, FSA if the business is offering, or HSA. Any tax benefit that you have through your job, you need to maximize those benefits. This is the last opportunity. Your last paycheck will be around last week of December, December 31st probably. So if you don't make the changes now, this week, you wouldn't qualify for that change. So if there's one thing you can do as an individual, try to review your paycheck. As a small business owner, please try to review how much profit you made this year so far, so you can try to pay some bills before the end of the year or delay some payments. So knowing information is the power here.
Okay. In this, in today's show, we have covered mainly federal-based deductions and standard deductions and expenses and credits and everything. Anything that you can add when it comes to state of New Jersey law, which might be a little different than a federal?
So
or something?
generally speaking, state of New Jersey will take the same benefits as the federal government. There are certain benefits that the state of New Jersey does not allow. So if you have a passive activity, the losses are suspended, not allowed. Charitable contribution has a benefit with the federal government. The state of New Jersey does not allow benefits for the charitable contribution. So there's most benefits for all practical purpose. The state of New Jersey allows follow the similar set of rules as the federal government. There are certain benefits the state system doesn't allow it.
Okay, all right. Now, when it comes to taxes, obviously, there are people who will always complain about the taxes, that not enough deduction, not enough credits and everything. My question to you is that will tax law change after year 2025? These are the, these are the expenses that you ran through for this year. But will it change after 2025?
It's very difficult to change the tax laws. So one big beautiful bill has set the tax laws for the next 4 years. There may be tinkering around it, there may be fine tuning around it. We are not expecting a large tax bill until the next government comes. So when the last time President Trump came in power in 2017, at that time we had seen a major change. After that, we did not see the change in the next government cycle. In 2025, we see the changes again, but we are not expecting major changes to happen in next couple of years.
Okay, next couple of years.
Until this government.
You can't make changes every year, right?
It's
It would
very
be-
difficult
it's
to
very
make changes.
difficult.
You can do the
Obviously,
fine tuning around
Yeah,
it,
yeah.
but making the changes of the OBBA type of
Yeah.
level is extremely time consuming.
minor changes are going to be
Absolutely,
there,
absolutely.
There will be maybe $500 or $1,000 more in a standard deduction
Right.
and stuff
There
like
may
that.
be more explanation that we said this thing, but we meant this thing
Yeah.
type of changes. But the major changes are not expected.
Yeah, because there is a tremendous amount of work involved and team force and everything in different departments, and they have to get the
Absolutely.
paperwork right and everything. So it won't change anyway, folks. So be very, very careful when you start planning for your taxes to file for the year 2025. Quickly, AJ, can you add a note or two on IRS tax audit in case if they have gotten IRS tax audit, what should they do for the next year?
Absolutely. So IRS is auditing a lot of people now, and so is New Jersey. If you get the audit letter, the last thing you want is to ignore it.
Okay.
Please make sure you bring it to your CPA, bring it to somebody's attention, make a quick call to the letter given in the notice, and make sure you respond to it. A lot of these notices are computer generated notices. They are just in error. You can explain it and the notice goes away. We do it every day. We see it every day. But make sure you're not ignoring the notice.
That's right.
Please.
Don't ignore it. That's really important. With that note, we come to the end of this week's episode, the Tax Talk with AJ. AJ, we'd like to say thank you so very much
Absolutely. Thank
for
you
your
so much.
guidance and information that everyone really needs to know when it comes to tax deductions and everything else for the year 2025. Until we meet again, same place, same time. First of all, wishing you happy holidays and also tax-free days ahead. So long.
Thank you.